So I've tried to hold off on this video for a little while, but I think it's time to get started on it. We're looking at revenues and expenses. Now, you'll already know about assets, liabilities, and owner's equity, but we need to talk about revenue and expense. That'll complete the set. We've only got 5 classes of account: asset, liability, owner's equity, revenue, and expense. And as you'll find out, revenue and expense is just a really special form of owner's equity. Okay, I'm going to put up some formal examples and then I'll run you through a quick example so you can see how it all works. So first definition here is revenue. Revenue is income earned by the business. Okay, it's money coming into the business for pretty much whatever the business does. If it's a lawn mowing business, it's money that comes in because you mowed some lawns. Pretty straightforward. Now the definition for expenses relies upon the fact that you know what revenues are. That's why we're doing expenses second. Okay, so what's an expense? Well, an expense is a cost incurred in the earning of revenue. So we can't define them both at the same time because expenses need to be defined in terms of revenue. So it's a cost incurred in the earning of revenue. Thinking about our lawn mowing business, really, really simple business. The expenses that a lawn mowing business might have. Mobile phone. You've got to have a mobile phone on you because people are going to call you and ask you to mow their lawns. You've got to keep putting fuel into the lawnmower, so that's a cost that's incurred. Now, people get confused between expenses and liabilities, but when you think about it, a liability is something that you owe. You owe someone and you're going to pay them at a later date. An expense is something that's happened. You paid some money out. The reason I wanted to talk about this now and not before is because now that we've done some transaction analysis tables and we've done a little bit of general journal stuff, we can look at this with some numbers and see how it would actually play out. Okay, so on the 1st of the 7th, Bob got paid $90 to mow a lawn. So I'm just going to put that into the general journal. You guys can do a transaction analysis table of it if you want to, but I'm just going to put it into the general journal here. 1st of the 7th. Now there's 2 accounts that are being changed here. First one's pretty simple. $90 got paid to the business. So that means that cash at bank is going to go up. And you guys know that cash at bank is an asset. Now, cash at bank is an asset, so we have to debit cash at bank. Let's do that now. Debit $90. So the problem is that there needs to be a matching transaction. There needs to be a credit. And it makes sense that there should be, because we'll call this mowing revenue. Revenues are credits. Now you might find this slightly odd because you think, oh, but money's going up. Why should revenue be a credit? Revenue is actually an owner's equity account. These are both modified forms of owner's equity. Because if $90 gets paid into the business, that means that there's more money in the business than there was before. And if you remember your formula, assets equal liabilities plus owner's equity, if assets went up by $90, something else has to happen. And the thing that happens is that your owner's equity went up by $90. So revenue is an owner's equity. It's positive owner's equity, so it's going to go up. Okay, and make sure that you're journalizing your general journal entries. So something like, I'm just going to be silly here, made money. You guys don't do that. You guys are more professional at home. Okay, and the second example here, Bob paid his mobile phone bill of $50. We better put a date on that. Let's say it's the 2nd of the 7th. All right, so again, you're going to journalize this entry, 2nd of the 7th. Now, I'm going to do things backwards here. I'm going to credit the cash at bank account. Debit, credit, cash at bank. I'm going to credit that $50 because it goes down by $50. Now we need a balancing transaction here, and our balancing transaction is going to be a phone expense, and we have to debit it. Why are we debiting it? Because expenses are owner's equity accounts, and owner's equities, when they decrease, you debit them. Okay, that's it. Make sure you journalize it. Paid a bill. That's it. A very short video explaining revenues and expenses. Don't be fooled though. This is difficult. This is the thing that people stuff up. So make sure that while you're doing this stuff, you are looking carefully at it and you are talking to me and saying, oh, this dude made some money. Can you check this, make sure I did it right? Or I'm not sure if this is a liability or an expense. Can you explain it to me again? Guys, I'm in class every day. Make sure you're talking to me about this stuff because this is where people get really confused about these things. All right, thanks a lot, guys. That's revenues and expenses.